Hi, this is Ivan Alon, the founder and chief investment officer at Align Wealth Advisors Investment Management, also known as AWAIN. Thank you very much for joining me today. This is the YouTube episode for April. And today there was some very interesting news that came out, and it was about the growth, the annualized growth rate that the U.S. economy experienced in the first quarter was 1.6%. This was way below expectations. So if that's way below expectations, meanwhile, inflation is well above expectations, certainly well above that 2% target that the Fed has as their ultimate destination for the growth of and the rising increase of inflation. This is a very unique situation, and it's something that I wrote about in 2021. And the title of the article is "The Maturation of U.S. Treasury Debt Held by the Fed May Pose a Big Challenge." And this was published actually December 8th, 2021. So there's something very interesting in this article, and one of the things I write one every month, so I do go back and kind of read these articles to see what I said in different points, and obviously things that we're saying here that I'm writing about in this article, this is what we're actually doing in our portfolio management, and we're positioning portfolios accordingly to things that I'm writing about here in this article, in various articles every month in Forbes. But at the end of this, remember, this was back in December of 2021, and I write, investors should be very clear about how they are positioned across their bond holdings, since the confluence of both the Fed's tapering of purchases and the natural maturing of bonds held could have a downward pricing pressure over the next few years. Shorter maturity bonds would be preferential. Certainly ended up being quite the case in 2022. Most investors hold bonds across varying maturity dates. Understanding how sensitive these bonds are to rising interest rate levels is a major factor in portfolio performance over the next several years. And then the final paragraph in this article, which you can find at Forbes, just Google my name and go to December 2021. The final paragraph says, rapidly rising interest rates without a robust labor market could mean difficult times ahead. As millions remain out of the workforce due to the pandemic, time will tell if they return in droves over the next 12 months. Their return is key to a less dramatic and stressful economic environment, which could otherwise be plagued with high inflation and meager growth, a unique condition not seen for decades called stagflation. And so that is the point of this month's episode, is to talk about stagflation. And that stagflation is a very real risk, and based on the data that we saw this morning, that growth came in well below expectations, and inflation hasn't abated, and that it's difficult to see that inflation will continue to go down. This is looking very much like a stagflation environment, and that's something that's highlighted not only by persistently higher inflation, but also higher unemployment, lower consumer demand, and of course overall lower and even falling GDP and gross domestic product. And so we're seeing that. We're seeing certainly something that rhymes with it in the current data that is getting released. And so thinking about how to position a portfolio in such a way that it is hedged in a stagflation environment. And of course, this is the kind of thing we're thinking about regularly. If the prices of things are going to be remaining higher, then looking at materials and and commodities like oil, for example. These are areas and sectors that tend to certainly hold their value a little better because they naturally benefit from the higher pricing. And people need to build things or repair things, and so there's kind of a natural consumption that comes around basic materials, as an example, but also through oil consumption, which is a factor of production in so many things. Not to mention, not least of which is energy consumption. So these are certainly concerns when you see that growth rates are falling, and on top of that, inflation is remaining higher. The Federal Reserve's next step is anyone's guess. Certainly our thinking is they're going to be very, very reticent to lower the Fed funds rate anytime soon. And already this morning they're talking about maybe December is when they'll make a rate hike, a rate cut. And okay, fine. But December, you might as well just say never. That's a long time from now, and there's certainly a lot that we can see happen in the marketplace between now and then. Certainly as the stress of corporate debt continues to become more visible. And we have not seen that happen yet. It is still very much obscured by very, very tight spreads. The risk that is perceived in the marketplace is certainly not present yet. So these are all things to keep in mind and be thinking about. And of course, we welcome the engagement and the discussion, whether you're a financial advisor or interested in our investment offerings for your clients, or a large direct retail investor interested to see how you're positioned for what may be coming ahead. Please don't hesitate to reach out to us. Thank you so much for joining me this month, and hope you gained some interesting insights, and have a wonderful rest of the month. Thank you.